Hi everybody, my name is Griffin Bridgers. This is the Basics of Generation Skipping Transfer Tax Part 12. Today we're going to dive into kind of the surface level view of GST grandfathered trusts and what they are, how you look at them, and how you analyze them, and what might happen if property is added to a grandfathered trust after a certain date. Now, as always, I want to remind you that this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, I know it's been a minute since the last time we did one of these, but if you recall back to Part 11, if you had the privilege of listening to that, we discussed crummy rights and how they might affect the GST tax annual exclusion of $16,000 per skip person for direct skip gifts. That was a good discussion. I'd encourage you to go back and listen to it and all the previous installments in this series. And there's a lot more to come as we're going to talk about, because there's a lot that goes into the GST tax. But before we get to that, I want to look at our subject today, existing trusts that might have been funded previous to the enactment of the GST tax, which happened in 1985. So we're not going to dive into the complex legislative history of the GST tax, because Congress took several passes at this in the early 80s. But the GST tax as we know it in its current form has really only been in existence since 1985. And as we're going to talk about a little bit later, the automatic allocation mechanism has really only been around since 2001. So what about trusts that might have been in existence on or before the date of enactment of the GST tax? Are they subject to the GST tax, and how? The good news is that we don't have to dig into how they might be subject to it, because these trusts are generally not subject to the GST tax. In other words, they've been grandfathered in. So, in other words, we refer to trusts that were irrevocable as of September 25th of 1985 as GST grandfathered trusts. And I've quoted the regulation down here, which really says Chapter 13, but we abbreviate that to the GST tax and really just say the GST tax does not apply to any generation skipping transfer under a trust that was irrevocable on September 25th of 1985. So there's the Treasury regulation where you can find that, along with a very complex analysis of what we're going to talk about today. And in a couple future installments, I'm going to do my best to compress that down to what you need to know. And I want you to keep in mind, this is a surface level view. There's a lot of nuances in that lengthy regulation that I'm not going to cover, because this is the basics of GST tax and not intermediate or advanced GST tax that we're talking about. But there are some bounds around this. So remember, I used that word irrevocable. So in other words, what this means is that for grandfathering to occur, the trust must have been irrevocable as of September 25th of 1985. Now, all trusts that are in existence on that date are presumed to be irrevocable unless, one, the grantor, if they had died on that date, would have had the trust assets includable in their gross estate under Code Section 2038, which is the code section dealing with a retained right held at death to alter, amend, revoke, or change the beneficial ownership of transfers to that trust. Now, note that it doesn't list out Code Sections 2036, 2037, or 2035, or even 2041. We'll talk about that another time, but another specific thing called out is if there's life insurance in the trust, it's not grandfathered as to the death benefit if the grantor on that date of September 25th of 1985 would have had incidence of ownership in the policy under Code Section 2042 had they died on that date. So those are really the two carve-outs. And there's a couple other carve-outs for wills and revocable trusts in terms of a date that they're in existence and the creation of irrevocable trusts under those instruments and the grantor's date of death. But typically, those exceptions only apply if the grantor or testator had died before January 1 of 1987. It's rare you deal with that type of trust, hence why we're not dealing with that narrow band within this basics discussion. But there's another, though, interesting exception which deals with QTIP trusts. So if you have a QTIP trust that was in existence on September 25th of 1985, regardless of whether the QTIP election was made before or after that date, the trust will be treated as if the reverse QTIP election had been made. So in other words, remember what we talked about with QTIP trust, that we have that switch we can flip from GST tax purposes to determine whether the deceased grantor or the beneficiary spouse will be treated as the transferor under that trust. The significance of whether they're treated as transferor is the determination of whose GST exemption applies. Now, if the reverse QTIP election was not made, typically that means that the surviving spouse would become the transferor of that trust at his or her death and would have to allocate their own GST exemption to the trust at that time. But we don't have to worry about that because the reverse QTIP election is assumed to have been made here, or deemed to have been made. So what this means is that no matter what, this trust is grandfathered. The surviving spouse, if they die after September 25th of 1985, will not have to allocate any of their GST exemption to this trust, even though the trust assets will be included in their gross estate under Code Section 2044 to the extent that a QTIP election was made. So, looking at this, a grandfathered trust is only grandfathered with respect to funding that occurred on or before September 25th of 1985. If there's any property added to the trust after that date, either directly or constructively, and we'll look at constructive in another installment, we're going to look at direct additions today, but any property added to that grandfathered trust after that date causes it to no longer be fully grandfathered. It essentially breaks the trust down into two portions. One is a grandfathered portion that's assumed to have an inclusion ratio of 0. The other is an added portion, which is assumed to have an inclusion ratio of 1. So what that means is that future transfers from the added portion will be subject to GST tax. But the catch is that when you make a distribution or when there's a taxable termination, there's no real ability here to preferentially take that from the grandfathered portion. What the regulations say is you have to allocate the distribution proportionately between the grandfathered portion and the added portion. Same thing, income and appreciation has to be allocated proportionally to these two buckets as well. So the method for doing so and the math behind it is driven by something called the allocation fraction, which is going to determine, one, proportionally how much appreciation and income is allocated to the grandfathered and non-grandfathered portion, and two, if any distribution happens, what portion of that is subject to the GST tax. So to determine that, you have to compare the fair market value of the grandfathered portion of the trust at the time of any addition to the fair market value of the sum of the grandfathered and added portions of the trust. In other words, the new augmented fair market value of the trust after the addition. By comparing those two amounts before or after, this allows you to determine what fraction of any future taxable termination or taxable distribution might be subject to the GST tax. So for example, we have a trust here that we're going to assume is valued at $1 million on the date of an addition. And then the grantor adds another $500,000 to the trust after September 25th of 1985. So to determine our allocation fraction, we have to divide the addition, $500,000, by the fair market value of the combined total with the addition of the trust, which is $1.5 million, which gives us an allocation fraction of 33.33%. What this means is that 33.33% of any future distribution or termination is going to be subject to GST tax, assuming that there is no allocation of the grantor's GST exemption at the time of that addition. Which, speaking of, you need to keep in mind that the effective date of the grandfather trust rule is September 25th of 1985, but the date on which automatic allocation of GST exemption kicked in was only for transfers after December 31 of 2000. So we have over a 15-year, or possibly close to a 16-year gap here, where essentially any additions that occurred between September 25th of 1985 and January 1 of 2001 must have had GST exemption allocated on a gift tax return in order to avoid using that allocation fraction based on a full dollar amount. So if you're analyzing trusts from this period and analyzing additions to the trust, you have to keep in mind that you have to dig into the history, especially on gift tax returns, and you can't just assume that there might have been automatic allocation of GST exemption to any additions that occurred before January 1 of 2001. And as we're going to talk about in the next installment, or at least maybe 2 installments from now, there might not be a directive addition, but there could be perhaps a constructive addition to the trust, such as, for example, perhaps the lapse of a power of appointment. But that's a subject for another time. So what's coming down the pike? I've kind of switched up our order, and the reason for my pause is really kind of wrap my head around the actual case study of what we've covered so far. So what I think is going to be helpful, as I've bolded further down, is really kind of taking things one by one for different types of transfers you might see on Form 709. And really what that's going to help us do is cover not just the GST exemption allocation, but just the gift tax reporting in general. And I think that works a lot better when you can look at specific types of transfers, maybe starting with 1, direct cash gifts. Next, looking at crummy powers, then going to common types of trust, like maybe a defective grantor trust or an eyelet, some strategies that might relate to those. Moving on from there to a slat, and then ultimately maybe a GRAT or a charitable lead trust, which is going to have its own carve out as you see in what's coming. We'll also talk about, coming up before we get into the case studies, reverse QTIP elections and mechanics, because I haven't covered that in great detail yet. The valuation of property and some of the principles that kick in under the GST tax principles. Gallo trusts, which are another special form of grandfather trusts. Then we'll dive into some questions on eyelets. For example, does it make sense with a term eyelet to allocate GST exemption? Then finally, we'll dig into the GST exemption allocation, not for transfers during life, but instead on Form 706 at death, and look at how that might be affected, for example, by the netting out of estate tax liability. So we have our ongoing glossary of terms for review, and today we've added another, allocation fraction, not to be confused with, at the top of the list, the applicable fraction, because the applicable fraction is really a comparison of the value of a transfer to the amount of GST exemption that's allocated to it, whereas the allocation fraction is a comparison of the addition to the trust to the total value of the grandfathered and non-grandfathered portion of the trust to determine what percent, as we discussed, of each future distribution or termination might be subject to the GST tax. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But I thank you for joining me for this part 12 of the basics of GST tax. I'd encourage you to listen to all parts and stay tuned for future installments as well, because there's a lot more to come. But thanks again for listening, and I look forward to seeing you in my future content.